I'll do some quick introductions here, right? So Justin is our very special guest with us today, obviously talking about all things taxes related to real estate, and hopefully how we can pay less of them, which is what my strong desire is in life, is to not pay taxes. So Justin, maybe if you could just share a little bit of your background. Maybe before you do, Justin, just I'll share how we met. Yeah, so we met through a mutual friend. Or a mutual acquaintance, if you will, out on the real estate syndication circles. And then I reached out to Justin because we have a property that we're looking for a new CPA on, someone that can do the taxes for us, handle all the K-1s for the investors. And that through that exchange, what I came to appreciate about you, Justin, and what I'm sharing with others here is that, it's one thing to have a CPA that understands taxes. It's another to have a CPA that understands real estate investing and specifically passive investing in syndications like what we do. And so that plus, I'll let you explain a little bit about your background, plus your background, I think really gives you kind of that unique position of you actually understand people's need, people's perspective, and kind of that strong, connection of how it weaves in, not just with general real estate investing, not just with general business type topics, but that kind of need of the entrepreneur as well as the real estate investor through syndications, and how that kind of can play into the bigger picture of, let's say, their portfolio, their need as a person. So
I appreciate that. And I appreciate the opportunity. Thank you. Well, I went into graduate school, finishing my accounting program and whatnot. I wanted to find some just real world level experience. Ended up doing an internship with a real estate investment company. And for 1 year, I prepared tax returns. And even at that point, I already had my job lined up with PricewaterhouseCoopers in Seattle. They hire a year in advance. So I was just wanting to get some real world experience before I went to work for the big boys, and did that. And when I got to Seattle, they basically said, "Oh, you've done real estate. Let's just keep you working in real estate." So great. I was just happy to be there, honestly. But I started working with cost segregation and high net worth individuals who invested in real estate development companies, just all these things that kind of dealt directly and indirectly with real estate. And the interesting thing is that 4 years after I started with PwC, the company that I had done an internship with called me back and said, "We really need a tax director, and we think you're the guy." So they hired me as their tax director, and I took my first house that I purchased in Washington, and I turned it into my first rental property. I worked for this real estate company as a tax director, but I was actually on the acquisitions team too. So I got to be involved with the underwriting and acquiring real estate and selling real estate and seeing what those, what the tax situations were there. And I loved it, and started investing with that company. 15 years later, I still invest with that company. So, nice. So in addition to everything that you were kind of walking through, I'm also personally a real estate investor and have done so for a long time. As a CPA of more than 20 years, my whole experience has been in and around real estate. And now as a partner in this firm, it's all I do. And the progression was kind of interesting because I went from working for that real estate company, didn't enjoy it. I missed public accounting, and was looking for an opportunity that way. And a lot of the investors in that company would come to me and say, "You're preparing, or you're overseeing the K-1s for 80-90% of our tax return. Why don't you just do the rest?" So there was an opportunity to just start my own firm. So I did. I hung the shingle, rounded out of my house, and right out of the gate, most of my clients were real estate investors. I knew what they were doing. I was familiar with what they did. I invested with them on a lot of the same properties. So it just was a natural progression. Wasn't getting enough traction. I needed more. And I was on LinkedIn. I was looking for just networking, just for an opportunity. And I saw an advertisement for a CPA firm that wanted a CPA with Big Four experience, a real estate background, an entrepreneurial mindset. And I thought, that sounds perfect. And long story short, and I don't want to give any wrong ideas here, but that was Provision, which is Tom Millwright's firm. A lot of people are familiar with that name. And I worked for that firm for 5 years. That's what moved me from Utah, where I was living at the time, to to Arizona, and I've been here now for 12 years. That was great experience. It was great training. We had an affiliation with Rich Dad Education. And so a lot of the clients that I worked with, if they came to our firm and they said, we're real estate investors and we want to work with a tax guy, just by default, because of my prior experience, even by then in 2012, they would just be assigned to me by default. And so it just kind of progressed from there. Fast forward to now 2017 and now 2018, 19, became a partner at the firm. All I do is real estate. This is my specialty. And I get referrals from other clients who say, I hear such good things about you or other prospects who say, my friend works with you. He loves you. And, they're starting a bakery, something like that's great. But, I really just do real estate, and I do it personally, and I help my clients do it as well. So
one of those initial reasons that I was like, oh yeah, like Justin's the guy. I mean, he understands it. He understands kind of the ins and outs of it, and he doesn't have to go research it to figure out this oddity of somehow this investment did whatever. It's that you understand it. Maybe a little bit about myself for those that are new. I won't deep dive into me, but I've been living and breathing real estate for a while now. We've been in the apartment space. As of late, we've been looking into some build to rent, which is also in the multifamily district, if you will. And then in addition to that, we have done a fund for, I would say, small multifamily developments. And so that's kind of where we cut our teeth, just a little bit of an intro. But we started Ridgeline really because we saw a way to help people kind of get into this space. And that kind of mentality is carried it over into really everything that we're doing now, including this boardroom meetup that we've been doing now monthly. And then the other side of it too, that we definitely want people to know about is the generosity component. In the boardroom kind of title, a lot of people kind of skip over it. It's like all things real estate investing, growing wealth and fueling generosity. It's like, oh, okay, it's great. The fueling generosity part is an area that we've just now started to work with, kind of trying to encourage in other investors. And I'm seeing more and more of it out in the industry. So we're excited about it. But kind of the idea behind that is, we can make a pile of money in real estate, but also we can make a difference with the stuff with all the profits that we're getting. And it doesn't just have to be our bank account that prospers. We can make a difference in the world. So anyway, if people want to know more about that side of things, I'd love to talk to them, even hang out for a few minutes after this, because it's important. And I think a lot of people are skipping over it these days, but it's a huge opportunity for us, especially whenever we're exiting these deals and Justin's helping us save, tens of thousands of dollars. And, it's a huge opportunity that I don't want people to just gloss over. So with that, I'll skip, some of the rest of that kind of intro there. I think a lot of people know us. I think you're familiar kind of with what we do. If you found us out on LinkedIn, or you've been, unless you've been living under a rock, maybe you don't know what we're doing. but that's kind of how our journey circled around. Started with the investing side, went into the apartment investing, syndications, which is what we do, fund, doing some small developments. And then we're also now this fueling the generosity machine is also becoming a lot of our dialogue. So, yeah.
Well, and honestly, taxes should be a part of that conversation too, because there's ways to do it creatively tax-wise that will benefit you immediately and still benefit your charity in the long run. And we can get creative. That might be a whole other call, but let's not leave that out of the scenario here. So
yeah, I do want to circle around to that if there's time. I'll say again, if you have questions, go ahead and put them in the chat. We'll start off with some of the ones that we've already gotten from investors. Just, we talk to, like you we talk to people all the time. And one of their biggest questions is always taxes and how it impacts like what we're doing. Kind of the generic question is, okay, how do you make the tax code work for you in building wealth? It's probably a little too generic, right?
That's a great place to start, actually. One of the things that I've learned over the years in my career is that oftentimes the biggest single expense that people have are taxes. So the more of those taxes you can keep, it's not what you earn, it's what you keep. And if you earn it, or you're able to generate this revenue, or this income rather, how do you keep it without parting with it with taxes? But kind of in a nutshell, and I went through your list of questions and I thought that's a really good question. One way to look at, and I'm going to frame everything in a real estate kind of context.
Yeah.
And that's really one of the reasons why I love real estate so much, is the benefits of investing in real estate can really just augment your wealth creation. And so the long and short of it is this: how does it generate your wealth? Well, it causes a positive addiction, because, long story short, or kind of a simplified example, and we'll run with this. And if any of you, and there's not very many on the call, so we can have questions intermittently, that's fine. But if kind of the quick example is, you invest in real estate, you accelerate depreciation, it shelters all kinds of cash flow income, and you don't pay any taxes on the income that year. Woohoo, you win. Okay, well, that was that year, but now you're on a hamster wheel, because now you're going to have to invest in something in the next year to shelter the taxes from the prior year, and it just keeps going and it keeps going, and you're swelling. You're just on this ride where you got to continue to invest, and then as you get into it for a few years, you can go through a couple of cycles. Some of those investments drop off, and then now you have more cash. Now what do? You got to do something with the cash, because if you keep it, you're going to pay taxes on it. If you spend it, you're going to pay taxes on it. If you invest it, we have an opportunity to shelter the income. So it just puts you on this investor hamster wheel where your wealth just will swell. And I think it's absolutely possible. I love to tell the story where, and it was a couple of years ago, you might all remember, and I'm not getting political, but it came out in the news that Donald Trump had only paid $750 in taxes.
Yeah.
And I got approached a lot. Justin, you're a CPA, you're a real estate CPA. Is that possible? Is that even fair? And my response was, no, I think it's awful. I don't think it's fair at all. He really should have been working with us. We could have made sure that was zero. He paid too much. And and that's the whole point. It's absolutely possible. And I know in real estate, and I don't mean to tangent too much here, you've got kind of two options. Maybe you're a general partner, maybe you're a limited partner. And a lot of times the LPs or the limited partners that I have that are clients, they want to walk through how it helps them. Well, I'll tell you from personal experience, I'm a limited partner. We hear about real estate professional, which we can talk about later in more detail if we need to. Real estate professional offers a lot of tax benefits in real estate that shelters an awful lot of income. Well, I'm a limited partner and I still invest in real estate for the tax benefits. It just is delayed, where if I have suspended losses in real estate for 1 year, in the next year, if one of my investments sells and now I have all this gain, well, all the suspended loss will offset that gain. Or if I had suspended losses in a particular property, when that property sells, if it sells for a gain, all the gain is sheltered by the suspended losses I couldn't take in the first year. So it's kind of a timing game. But once you get on that cycle, year after year, you've got ebbs and flows. These income streams will be offset by these other loss streams, and it all balances out, and your wealth will just swell.
Yeah. So I think a few questions come in for people that may be less familiar with the hamster wheel cycle that you were talking about there. But before I jump into that, so one of the questions that we had previously was, is tax-free wealth possible? And I think you answered it.
Yeah, exactly. That's the point I was trying to make.
So to peel that apart a bit so people can understand, I guess, walk us through kind of in a little bit more basic form, like what does that process look like for people? So let's say someone's coming into this investing in property one, right, that they're going to hold for some number of years, and they get income, they get depreciation, they get these things. How does that show up for them that helps them in the long run as they're reinvesting, or even on that one property, right?
Yeah, that's a good question, because if you just invest in one property, to keep it simplified, it's your first property, you've invested in the one property, and it might be on that on the underwriting or the projection on the offering memorandum or the PPM, they said that they're going to hold it 3 to 5 years. Well, if that's the one and only property that you own, then there are still immediate benefits, because if we accelerate depreciation, so for example, if I buy $1 million property and I have, when you buy a property, you have to allocate between the land, which is not going to wear out, so there's no depreciation for that, and the building. Typically, I've seen that 80-20%. There's arguments that could be made that that's not the right approach to use anymore. And I don't think the IRS necessarily likes it. We don't need a tangent or go down that rabbit hole. But just for an easy example, if I have $1 million property, a $200,000 piece of land, and an $800,000 depreciable asset, that's going to generate roughly $30,000 of depreciation expense on a 27.5-year residential rental asset. That's without cost segregation. But I'm just trying to simplify here to show that answer your question. What that means is that property can generate $30,000 of positive cash flow, positive income every year that will be completely tax-free, because depreciation expense is a paper deduction. You don't write a check for depreciation. You're just kind of taking exactly. You're just taking a chunk of your building every year in a rate set by the IRS. And so if that's positive cash flow of 30,000, then I have $30,000 deduction. That's $30,000 of cash I can put in my pocket and not pay taxes on. And there are so many tangents we can make from there, because I know people will say, well, but you're gonna pay taxes on it eventually. So maybe, but then we're on that hamster wheel. Maybe when that one comes due, you go get another one, or before it does, you get another one, and then you have these cycles where they offset each other, and it works out beautifully. And lost my train of thought, kind of where I was going, but the point being that depreciation expense is one of the biggest reasons that I love investing in real estate, because it's completely paper, it's non-cash, and if I bought that $1 million property, I didn't come out of pocket $1 million. I put in a down payment, and I leveraged as much as I can beyond that. So I might be out of pocket $200,000 on an 80-20 loan, or I know that's kind of pie in the sky thinking right now. I've seen lots worse than that, but just for easy math, 80-20 loan, $200,000 out of pocket buys me $1 million asset with a $800,000 depreciable asset that generates a $30,000 a year cash or deduction, non-cash deduction. That means that if I generate $30,000 of positive cash flow, that's $30,000 of tax-free income. So that's kind of a simplified example, but that's definitely one way it works.
Yeah, and maybe to expand on that. So that's like one asset, you come in, you can do that, and that's helpful. But to your point, eventually that property is going to sell, right? And you're going to be faced with this beautiful thing called a lot of profit from equity that's been cooked in. You got this equity, nest egg that just kind of rides along and grows with the property, right? And then you go to sell, and you get this wonderful gift to all the investors called an enormous return at the end of the deal. But you also get this wonderful gift from the U.S. government where they want they want to be paid, right?
Now, so in a couple of ways, because you got depreciation recapture, and which people think is a bad thing. We'll talk about that. I didn't mean to cut you off. You have a question, but yeah, there's definitely going to be some freight to pay at the end unless we do something about it.
Yeah. And I think that's what I think the experienced investors get it, right? They've been through a cycle or two, and they're like, this is how it works. I think for the new investor that may be in one deal, or maybe if they're in two deals even, they haven't seen that cycle yet, right? And so they don't quite have that vision of what does that really look like. But maybe walk us through, so the benefit of these multiple cycle deals and how that can help an investor who's maybe one deal is exiting and they're getting this huge lump sum of money show up in their bank account, but how this, let's say, snowballing effect of saving on your taxes, if you will, how that's possible through these multiple investments, right? How are you not paying, $10,000 in capital gains tax, right? When you sell the property, as an example, how are you writing that off, right? That's the part that I think a lot of people are not conceptualizing if they haven't been through it, you know?
Yeah. And in some ways it's viewed as too good to be true, but people do it and it is true. And let me tell you, it's not a loophole, it's not hoodwinking, it's not kind of short change. This is the law as it was written and why it was written, to incentivize you to make that investment. The government wants you to do that. It pumps money into the economy, it provides jobs, it provides housing, it does things that we as entrepreneurs are good at doing, or that we can focus on doing, that the government is not good at doing. So, but to answer your question, kind of conceptually going back to that $1 million example that I mentioned, if I buy that $1 million property, $200,000 down payment gives me an $800,000 depreciable asset. And the $30,000 amount that I use is just general straight or residential depreciation for a residential property of over 27 and a half years. So it comes out to like 29 and change. I'm just rounding up, but that's not accelerating depreciation. If we accelerate depreciation through something like a cost segregation study, then maybe 25% of that 800,000 will get reclassed out of that 27 and a half year category, and they'll get put into a 5, a 10, a 15, or even a 20-year category, which is eligible for immediate deduction under bonus depreciation. So that's fantastic. In 2022 was the last year that we had 100% bonus depreciation. In 23 now it's at 80%. It's set to go to 60% in 24. Even if it goes, and I say if because there's already talk that it'll be extended to, because of inflation, that there's got to be things that the government can do to kind of right the ship. If it goes to zero, which I don't think it will, but if it goes to zero, I would still do a cost segregation. I would accelerate that deduction as much as I could, again, because it's a non-cash deduction. That offsets a lot of income. So if in the first year I invest 200,000 and in year one I get say 180,000 or even $200,000 back on my K1 as a loss, or on the property as a loss, that loss is a passive loss. Passive losses for tax purpose can only be used to offset other sources of passive income. So you asked, how does this help? If you just one property, that passive loss will be suspended until you do have passive income, which if that's your only investment, that's not likely going to happen until that investment starts to turn positive income after depreciation. Then the depreciation you couldn't deduct in year one, you'll be able to deduct in years 3, 4, 5, and so forth. But if you had another asset that is generating income, and then you have the new asset, the new investment that is generating this loss, the loss from the new asset offsets the income from the first asset, and round we go. And we accelerate that depreciation. And the next year, this is where I was saying, we get on this hamster wheel where we're having to find investments year after year, or at certain intervals of time, so that we have this continual offset, one of the other. If you hit stop, then at that point in time, you may have some taxes due. We'd have to figure out a different strategy, but that's pretty short-sighted, because we can go beyond that too and figure out how to pass these assets on to your heirs and potentially never pay tax. That's, again, it's not a loophole. It's not cheating the system. It's using the system precisely as it was designed to be used. And so I encourage that. I love that. And may have sidetracked a little bit, but I wanted to answer your question there, that is possible as you continue to swell with these investments, one will offset the other. And potentially you're paying very little, if any, taxes. It's very possible.
Yeah, and I think the key to kind of summarize some of what you were saying here, the key is really, by doing that bonus depreciation, you're effectively squishing those paper losses forward, right? So instead of just taking them at some point in the future, you're forcing them all up into the front end of the system, right? And if you don't, I think the beauty of the tax code is that if you don't use them, they don't evaporate. So if you get, let's say that your example, 150,000 in depreciation, and you had 100,000 and let's just stretch it a little bit. Yeah. In profit that year, right? That extra 50K doesn't just vanish in that year one. It gets carried forward on this lovely piece of paper on your tax documentation that hopefully your CPA files.
Yeah.
So you don't lose it. And it just rolls into the next year, right? So if you didn't take it, then it's there to take benefit in the next year.
Right.
And then by doing that in multiple properties, as you're having these multiple paper losses adding on top of each other, again through your K1s, then it as one sells, you still have this nest egg of depreciation that you can revert back into that can obviously offset some of those incomes. Yeah.
I was going to make a point, and then let's jump to that question, because I remember one of your questions was, can I offset my capital gains tax in passive investments? If I'm understanding the question correctly, let's consider a couple of things. If you sell an asset, a property that you've held for more than a year, that's going to be taxed at capital gains rates, right? But if you've had these losses that you were just describing, that you weren't able to use them all and they're stacking up year after year, or you're just not able to use them all, when you sell your real estate, even though it's taxed at capital gains rates, because the asset was used in a passive activity, then the gain will be offset by passive losses. So it's kind of a win-win scenario, I think. So in that regard, then yes, your passive losses can offset your capital gains when you sell property used in a passive activity. But if the question was, I made 100 grand in stock sales, and that's not passive. The three categories are active trader business, portfolio, which is stocks and bonds and interest and dividends, and then passive activities like real estate. And not just real estate, anything rental, anything passive. It could be a business. If you're a silent partner, you don't touch the business, you're just a money partner, that's passive to you. So there's all kinds of things that way. But there are ways that if we qualify, I mentioned before, real estate professional, if you qualify as a real estate professional, and I'm happy to share how you do that, then the losses in real estate could offset your capital gains if you sold stock. But you have to jump through some hoops. So,
but even in the nuance of some of what you said is a big question that I misunderstood early on in the real estate game, and that was, I've got all these losses, and I sold this stock for a gains. Well, I've got these losses. My stocks are passive. I'm not doing anything in them, but they're in different categories, right? They're not the same. They're not in the same bucket, right? So they got to be in that same passive bucket. And stocks, I think, most stocks, if not all, are not in that passive bucket.
You make a good point, because what did you do for the stock? You did nothing. So in that sense, it's passive. But just as real estate is passive by definition in the tax code, when you sell stocks and things of that, paper assets like that, by definition, those are portfolio assets. So they're not in the same bucket, like you mentioned. They're not in the same column. Yeah. So they don't offset automatically.
So Jeremy's got a question here. Hey, Jeremy, by the way, good to see you. Been a while. Does bonus depreciation from a new asset offset all types of income from the sale of another property?
That's a great question. And it's just like I was describing. And let me say something. I have all the faith in the world in my CPA brothers and sisters, but I see that missed a lot, because they'll say, well, you held that property for more than 12 months. It's a capital asset. And if there's gain to pay, if there's taxes to pay on any gain, it would be taxed at capital rates. So long-term, if you held it for more than 12 months. But you got to remember what I said, that if the asset was used in a passive activity, then it is a passive gain that could be offset with the bonus depreciation that Jeremy just asked about. And honestly, I see that missed a lot.
And I think that is an enormous path of snowballing the wealth. Yeah. And to your point, it's missed, but it's a considerable miss if it's missed, because maybe for people that don't quite understand what I mean by that, if you look at your profit, if you say, okay, if you look at the 100% of profit that you're going to make from a property, yeah, some of it's from income, from rent and things like this. And then the rest is just the equity that's building in the property over time that you're going to get when you go to sell it. I would venture to say the numbers have greatly changed, by the way, over the last year. But let's say in normal times, let's assume we're coming back to sanity very soon. I would have expected around 60% of the profit or more to have come in from that capital event when you go to sell the property. That is an enormous amount of your profits, right? So to put numbers to it, right? If so, a lot of people target like 2 times equity multiple, meaning you invest 100K, you should expect that 100K to double to 200K. Yeah. And if you think about that from a profit perspective in the scenario I just said, then you're getting $60,000 of capital gains, right? In the scenario I just described, to kind of shorten that cycle, right? It's like if you invested $100,000, you're making profit of roughly, let's say, if my scenario is true, then you're getting 60,000 of that or more at the exit at capital gains. And if someone misses what you just said there, Justin, if someone misses that, that's a significant tax burden that you could have offset.
Correct.
And the reason it's important is that that's a significant tax burden that could have been invested into a new property, making, these minions we call money working harder for you for longer for the next years to come until your next capital event. Yeah. Anyway, just to put some color, maybe, if you will, some of what we're saying.
Precisely right. And that was a great example, a great explanation.
This is the circle back moment, Justin, because I get this question a lot, right? And not being a CPA, I often don't like answering it and tell people go talk to your CPA. So the question around capital gains, and for some reason people get stuck on capital gains a lot, but do people typically come out ahead even if they pay capital gains tax or depreciation recapture compared to like their income and their stock investments? That's a completely loaded question, and there's 1,000 variables that are in there. But just, I think where it's stemming from is that idea of people are stuck on, you're going to pay capital gains anyway, which we've just defined, not necessarily. And then the other side of it is that depreciation recapture. They think that, okay, you're taking all this depreciation, but one day you're gonna have to pay the piper, right? Which is true to a certain extent. And I think that side of it may be kind of the next topic that may be helpful to people to capture, because a lot of people don't understand depreciation recapture. They hear paper losses, passive losses offset passive gains, awesome. But they forget there is this depreciation recapture, but it's not like the death to your income, right? Maybe you can explain a little bit about how that works in this scenario.
Oh, I'd be glad to, because it's something that I've talked to a lot of people off the ledge, because they're like, well, why would I even bother? I got to pay it all back in the end anyway.
Exactly.
And like, all right, well, let's keep it real simple. Would you rather have the dollar today or the dollar tomorrow? Because if I deduct it now and I don't pay it back for 3 or 5 years, deal, I'll do it. And that's an absolute worst case scenario, but let's make it an even sweeter deal. So for example,
well, before you go on, because of inflation.
Oh, inflation. Yeah. I mean,
right. If my dollar can be working for me now rather than disappearing, right? Or, it's like inflation is going to kill that dollar eventually. So yes, keep it working. And in the very least.
Exactly. And this is one of the reasons why I love real estate, is because, you buy the asset and you do nothing to it. And just by virtue of time, it just will appreciate in value. In the meantime, you're taking a deduction for it. So that's very different than stocks and bonds. You make an investment in a stock, you don't get a deduction for that, but you do in real estate. You're going to depreciate, you're going to get a deduction. Did you have to pay cash for it? No, it's a paper loss. It's a paper deduction. In the meantime, the asset ostensibly is increasing in value. So they're like doing this great thing, which kind of gives rise to what you were saying. Well, then now I'm going to sell it with this you can do forced appreciation by making improvements, but you'll have market value appreciation. It's just going to raise in value, demand. Or like what got me on the whole point was you mentioned like inflation. That's what I love about real estate. It's a hedge against inflation, because as the dollar goes down in value, well, the real estate is keeping pace with the increase in appreciation, and you're not losing any value there, because the real estate's going to go up just like appreciation is going to go up.
Yeah, thanks for expanding on that, because I just dropped it out there and assumed people understood it. So,
yeah, so a couple of
but
things
on the depreciation recapture side,
yeah.
so like why should people worry or not worry about that?
Well, this is where it gets really fun, and I'll use the highest tax rate just to illustrate the point. Then you can apply it to your own scenario. But depreciation recapture came into play because when you take depreciation deduction, you're getting an ordinary deduction. So whatever your tax rate is, and I'm just going to use the highest tax rate, 37%, as an illustration. That meant that I get a deduction at a 37% deduction, right? So then later on, you'd sell it and you'd say, well, I held the asset for more than 12 months, so I'm going to pay taxes at capital gains rates, we'll say 20%. And that's where the IRS said, hey, wait, no deal. You got an ordinary deduction and you paid taxes at capital rates. They're like, that's not fair. We're going to have to find some middle ground and balance this out, and then in comes depreciation recapture. But here's where it becomes a sweet deal. Let's say you did get the 37% deduction because you're in the highest tax bracket. The maximum depreciation recapture rate is 25%. So even if I have to pay back or recapture all that deduction, depreciation, it gets recaptured at 25%. If I deducted it at 37%, that 12% differential is a permanent tax savings you will never, ever repay. That's there forever. In the meantime, like I said, if it's 3 to 5 years, you got use of the cash. So basically, you got use of the cash now at a 37% deduction, used it for 3 to 5 years, and then paid it back at 25. Deal. I'll do that all day.
Yeah.
You know what I mean? It's like the time value money tells you it's a good deal.
It's a good play. Yeah.
Absolutely.
But it's not always 25%, right?
Correct. So say, well, Justin, that's great, but I'm not in the 37% tax bracket. So let's go even the other direction. And let's say you're in the 20% tax bracket, or less even by chance. Depreciation recapture is taxed at your ordinary income tax rates up to 25%. So if you're at 20%, then your recapture rate is at 20%. If you're at 27%, now finally depreciation recapture caps at 25 and your ordinary tax rate is 27. So hopefully that makes sense. But that's where I say it's not a bad deal. I don't know. I have heard, I mentioned that even from my earliest years as a CPA 20 plus years ago, I was doing cost segregation. I would talk with other CPAs that would say, well, I don't know why anybody would ever do that. You're just going to have to pay it back anyway. I said, well, clearly you don't understand the time value of money, and they don't understand the differential potential in the tax rates there. It's a good deal. It's not a bad deal.
It's a good deal. Yeah. I mean, if you can number one, if you can keep your money working, it's actually working for you, making you money.
Yeah, right.
Two, if it's working in an asset that is beating inflation, it's a double win already, and then the third one is at the very worst case, it's going to get taxed late. If it was taxed today or taxed later, it's still going to get taxed. But in the worst case, it's taxed at your income. In the best case, if you're a high income earner, which we all hope to be, if not already are, then you're getting a benefit of not hitting the
arbitrage there. Yeah, exactly.
Yeah. A couple more questions came in here. Yeah. Is there a way to manage paying capital gains tax at a lower rate? Yeah. And maintain bonus depreciation to offset active income if you can qualify as a real estate professional?
Well, so the quick answer is yes. The trick is qualifying for real estate professional, because once you do, then you can take your deductions, your passive loss deductions without limitation. There was kind of a new law. I'm not getting political. I won't name names, but I won't say. I better not say.
Certain people in our country have
people that are in control. They introduced this concept called the excess business loss limitation. I'll give you an example. common scenario, I would have a high wage married couple where one spouse was a high wage income earner, maybe a medical professional, high income, and the other spouse was the real estate professional. So the high wage earner generated the cash to use as the capital, the resources to buy the assets, and then the other spouse, qualified as real estate professional, jumped through all the hurdles and or jumped through all the hoops and over the hurdles. And it was not uncommon that I would have clients that were one spouse made $1 million, the other spouse invested and they offset the $1 million. They paid no taxes on that income. It's fantastic. That's where I'm saying 750 for Donald Trump. That's too much. He should have really did some better planning there. No, he's got brilliant tax guys. Don't take me wrong. But now there's this thing called the excess business loss limitation. It's gonna, and I forget the number. It's 500,000 and change, maybe like 560 something thousand. That's the most that you can offset. And if you can't offset it in that first year, it rolls forward to the next year. It becomes net operating loss, which now you can deduct without any limitation. So all they did was delay the inevitable for a year, but it still kind of stinks when you used to be able to offset $1 million. Now you can't. You can only offset about $500,000. So, and I don't know if I tangented too much, but the quick answer to your question, Jeremy, is that, yeah, if you can qualify as real estate professional, so you've met the hours requirements, and I don't know if that's what you were meaning by maintaining the capital gains rates, because there's not really any hours consideration there. It's just a holding period that if you have capital gains in your stocks and your stock sales, but you have losses in real estate and you qualify as real estate professional, they will absolutely offset. So you'd pay no tax on your capital gains. In fact, a lot of times, especially this time of year, I'm meeting with a lot of clients. We're doing year-end tax planning. Now, we don't only do year-end tax planning because I believe in year-round tax planning, because the saying goes, if you want to change your tax, you need to change your facts. If you bring me your documents in February and March and say, here's what I did last year, now get me out of paying taxes, we can't wave the magic wand and make it go away. At that point, it's beyond the opportunity to change the facts. We need to be meeting during the year, kind of seeing what's coming, and then stack up the fact pattern to the most advantageous, in the most advantageous way to benefit you tax-wise. The point I was getting at is now here we're doing year-end tax planning, or maybe it's my third or fourth time meeting with clients towards the end of the year. If they've got losses in real estate, they're going to qualify as real estate professional, and they've got more losses than income. Now we start looking at other positions that they could liquidate for a gain, and then again, not pay any taxes on it. Mm-hmm. So it's not a bad deal.
So another question from Josh, following up on passing properties on to your heirs. Does the same tax rules apply if the property is owned by a trust instead of an individual?
Great question. And the quick answer is yes. The trust it won't change the nature of the key factor there is the holding period, and changing from an individual to a trust won't change the holding period, especially if it's a living trust, because the living trust is basically your alter ego. A lot of times living trust doesn't even have their own separate EIN number. It uses your social security number. So what you contribute when you contribute to a trust, you contribute the asset, but you also contribute the holding period. All of the tax attributes go in with the asset. So the quick answer to that question is that, yeah, it would still work that way.
And then another follow-up from here was,
if you need to take the funds and you have to pay tax in some way, right? Because you're going to have a redeployment of the capital. You have to use it for personal reasons. And you have to get it out. Your income tax is significantly higher than the capital gains tax. Can you preserve the depreciation for the actual active income and pay the capital gains rate? Or for that example, the depreciation recovery, and preserve the other for the higher income offset?
And maybe I'll oversimplify this, because the quick answer is there are ordering rules when you're preparing your tax return, when you're reporting all the income, and you're taking loss deductions. And if you have bonus depreciation to be taken, it will offset all of your income before any income is even eligible or subject to the capital gains rules. So if what I'm saying is, if maybe if you had bonus depreciation through cost segregation or what have you, where you had enough that you could offset some of your income, but not all, and the income that was remaining was capital, not active, because the bonus depreciation will offset the active first, then the portfolio, and then the passive. So then whatever's left would be subject to capital gain if that was your source of income. So I mean,
Okay.
if the bonus depreciation offset all of your ordinary income, great. And then the rest of your income that didn't get covered was in the capital bracket or in that category, then it would be subject to capital gains rates. And that's precisely why I was mentioning before, we like to do year-round tax planning with clients, not year-end tax planning. Because even now, if I was seeing a client for the first time now, there's only 4 or 5 weeks left in the year. What can you do with 4 or 5 weeks? You need to stack your fact pattern mid-year at the latest, at least be ahead of that. So if what you just described, if partway through the year you saw that coming, then we can build a fact pattern that would hit that sweet spot that you just described. This is one of the things that we talk a lot about at the end of the year. A lot of my clients, they'll either pay a tithe or they're very passionate about whatever charity or purpose they like to stand behind and fund. I'll just make this quick. Maybe they've got hundreds of thousands, $1 million or more, and they're like, what am I going to do with this? I want to give it all to them so I don't have to pay taxes on it. And that would be one way of doing that. Give it to the charity, but you don't want to give it to the charity all at once. You can create a charitable trust where when you make the contribution into the trust, boom, you get the deduction for the full amount. So let's say you put $1 million in there, you get the deduction all at once, keeps the government's hands off of it, goes into the trust, of which you could be the trustee. So now you get to decide. And it's a beneficiary trust, so the trust has to have a named beneficiary. Presumably this is your chosen charity, right? Or whatever cause you want to stand behind. Now you get to set the faucet at whatever rate you want to. So you get the deduction all up front. Maybe you had a windfall and you just want somewhere to park it. You want to give it all away. But you're not going to benefit from a charitable you're not going to want to give the charity all that money all up front, all at once. Put it in that trust. You get the deduction all up front. It shelters the income, keeps the government's hands off of it. And then you can just kind of sift it over to the charity at whatever rate you choose, and it has to abide by the terms of the trust. So that's something that you'd work out with your attorney when you set that up. But that was just kind of one of the things that we talk a lot about, because if they wanted a big deduction, but they didn't want to give it all at once, put it in the charitable trust and then just sift it off little by little.
Interesting. Yeah. I haven't heard of that. I've heard, yeah. Well, I think we're at the end of our time. So I came up with like 6 other questions. So
well, luckily you've got my phone number. So.
That's right. But Jeremy, for people that are here, and also a lot of people watch this later, what's a really good way for people just to get in touch with you, whether they have questions about today or if they've just realized that, oh man, I need somebody that understands real estate. What's a good way for them to get in touch with you?
One of 2 ways I think are the best. I would say you could email me directly. I get flooded with email, and so I have an assistant that helps me with that. But the email address is my first initial last name, Justin Jensen, J Jensen, Jensen. This is where it gets ridiculous, and we're gonna change this in the near term. Oh, there you go, at morrisonclarkcompany.com. The other way that I've noticed in the last couple of years, a lot of people are finding me is through LinkedIn. Mm-hmm. And I do use LinkedIn, and there's a lot of information on LinkedIn. My LinkedIn profile is LinkedIn/Justin S. Jensen. So it's pretty straightforward. It's not one of those gobbledygook numbers that you have to, it's just my full name, Justin S. Jensen. So that's kind of a sneaky backdoor way of doing it, because I get a flood of emails that if my assistant doesn't pick off a name and say, hey, you need to respond to this one, it could get missed. But I monitor LinkedIn and I look at it every day. And so then I'm like, oh, well, I'll just hit that one real quick. So probably the best way. The other way is you could just call our offices at 480-424-7855.
Well, Justin, thanks so much, man. I did want to share these two quotes. Someone sent me one of these recently, but the hardest thing in the world to understand is the income tax, Albert Einstein. And then the other one is I am sharing the screen. You can see that, right?
Yeah.
Okay. And then the other quote was from Mark Twain. What is the difference between a taxidermist and a tax collector? The taxidermist takes only your skin. Yeah. So I pass those on to everyone free of charge. You can thank me for them later. Take a screenshot. Yeah. Yeah. The other part is, so the next month we're looking at, in somewhat relation to a carry on from this discussion today, is kind of setting kind of the best practices and looking forward into next year, and kind of how do we start gaining momentum as we're getting closer into 2024, so that we're not thinking about 2024 when it starts, but more from the perspective of, okay, we're closing things out now. We need to jump forward, both for business and investing. It's going to be December 29th. Same link, yeah, as here. This link here, honestly, is just going to redirect you to the sign up sheet that everyone came into for today. Yeah. The only other topic I would touch on was we do get asked time to time about live opportunities. I will say that we're governed by some SEC rules. So if you're interested in those, please do reach out to me, but do that through our system. We got to form a relationship with people. Yeah. And I think in general, for me, what I like to draw people more towards is, we want to be able to serve people in a way that actually meets a need, right? And so we want to have a real conversation that just looks at, are we a good fit for people? Yeah. And if we're not, then we're not. But it's more through that conversation of, okay, where are people wanting to get to with their goals? Similar to what you were saying, Justin, with their taxes, you got to talk early on about where are you trying to get to, and is this a good fit or not? And are we a good fit or not? But for people that just maybe want to be a fly on the wall for future deals, or if you just want to have that conversation and grab some coffee on Zoom, you can just hit me up. Yeah, if you go to investwithbrady.com, it's actually going to redirect you to our landing page for a quick form, and you can set up a time to talk to me. Right after that, love to talk to people and love to help them, especially as they're looking at some of the topics we talked about today. So with that, we're going to stop it here. Appreciate everybody joining. Justin, a wealth of knowledge. Again, we had probably another 3 hours we could have touched on a few of those points, but
I was just getting started. And I have to say, and I am so sorry to say this, but my insurance company appreciates it when I say that none of this can be used as tax advice. These are all just scenarios. You have to talk with the CPA about your specific set of circumstances to make sure that it would apply to you. So
absolutely,
that's the disclaimer. And it's unfortunate we live in that world, but I've failed to mention that before. So
absolutely. Well, Justin, thanks so much. For those that join us, thanks. And for the people that are watching this later, please do reach out to Justin if you do have questions. Have a good night, and we'll talk again soon.